86.1 million ounces. That is the exact amount of silver sitting in COMEX registered vaults right now, the metal officially designated as available for delivery against futures contracts. I want you to hold that number in your head, 86.1 million ounces, because on a single day this week, a single day, traders filed delivery notices for 52.63 million ounces. That is 60% of the entire deliverable inventory demanded in one morning. And here's the part that should stop you cold. Silver is sitting at $83.48 as of March 6th, 2026. Not $120, not the all-time high it hit just 37 days ago on January 29th. $83.48, down 33% from a record that the mainstream media barely even covered. And inside the next 72 hours, every data point I'm about to walk you through is converging on a number that traders in the know are already watching very carefully. $84.33. By the end of this video, you will understand exactly why that number matters, where it came from, and what happens to the silver market if it breaks through it. Stay with me. Before we get into the mechanics of what's driving this, I want to ground you in something. This isn't a price prediction pulled from a chart or a YouTube thumbnail. The $84.33 level is a specific technical and structural confluence point that emerges directly from COMEX delivery data, Shanghai price spreads, and the current inventory crisis that, frankly, most retail investors have absolutely no idea is happening right now. The data is public. It's on CME Group's own website. It's in the official warehouse reports published every single business day. I am not asking you to trust me. I'm going to show you the numbers, and you can verify every single one yourself. So let's start with where silver is and how we got here, because the context is everything. On January 29th, 2026, silver touched $121.62 per ounce, an all-time record high. Within days, it collapsed, wiped out nearly 50% of its value in what U.S. Treasury Secretary Scott Bessent publicly attributed to Chinese traders engaging in a speculative blow-off. The mainstream financial press ran the bubble burst narrative. Social media called it a squeeze that failed. And the casual investor, the one watching CNBC between ads, probably thought silver was done, finished, back to being the boring little brother of gold. But here's what they missed. Here's what I need you to understand before anything else. The crash did not fix the underlying problem. It accelerated it. Let me show you what actually happened in the weeks after that crash. COMEX registered silver inventory, remember that's the specific pool of metal available for physical delivery, stood at 167.7 million ounces back in October 2025. By the end of February 2026, that number had fallen to 86.1 million ounces. That is a 38% collapse in just over 3 months. The drainage rate, according to CME warehouse data as of early March, is approximately 785,000 ounces per day. Every single trading day, 785,000 ounces of physical silver is leaving the COMEX system. Think about what that means geometrically. You're looking at a bathtub draining faster than it can be refilled, and somebody just pulled the plug wider. And this wasn't hidden. CME Group publishes this data daily. The COMEX Stress Index, a composite measure that combines coverage ratio, inventory trend, paper leverage, and vault outflows, sat at 81 out of 100 as of March 5th, 2026. For reference, all-time high on that index is 88. We are 2 points away from unprecedented territory. The all-time low is 14. We are at 81. That is the market screaming in a language most people don't speak. Quick message for those who haven't subscribed yet. My analytics show about 3 out of 4 people watching right now aren't subscribed. If this kind of data-backed analysis is cutting through the noise for you, if you feel like you're actually learning something that isn't being covered on mainstream financial channels, hit subscribe. That's how I know who the serious community is. It helps the algorithm surface this content to other people who need to see it. Now, back to where this gets truly alarming. Let me give you the paper versus physical reality because this is the heart of everything. Right now, are 6.9 times more paper silver claims outstanding than there is actual deliverable silver. 6.9 to 1. Every ounce of silver that is officially available for delivery on the COMEX exchange has 6.9 paper claims sitting on top of it. And when markets are functioning normally, when the vast majority of traders are rolling contracts forward and never actually demanding the metal, that's fine. The whole system is built on the assumption that most people don't want delivery, they just want price exposure. But here's where February and March 2026 have shattered that assumption entirely. February is historically one of the lightest delivery months of the year. Typical February COMEX silver deliveries run between 3 and 5 million ounces. This February, 5,036 contracts were delivered, representing 25.18 million ounces. According to the CME's own delivery data, that is the highest February delivery volume in modern COMEX history. And then, on first notice day for the March contract, February 27th, traders immediately filed for 10,526 contracts. That's 52.63 million ounces demanded in a single morning. This is not normal market behavior. This is an industrial allocation mechanism. The people demanding delivery aren't speculators. They're manufacturers. They're solar panel producers. They're electronics companies. They're EV battery fabricators. They need the physical metal to keep their production lines running. Now let me connect this to the $84.33 number, because it's time. Silver closed at $90.10 on February 27th. That was first notice day, when delivery demand spiked. It then pulled back through the week of March 3rd, trading between $82.46 and $85.69 in a range that reflects maximum uncertainty. On March 4th, it hit $85.69 before pulling back to $82.78 on March 5th and recovering slightly to $83.48 by March 6th. What technical traders are watching right now, and what the options market is pricing in, is whether silver can recapture and sustain $84.33, which represents both a 61.8% Fibonacci retracement of the March pullback and the exact midpoint of the delivery stress zone. Below $84.33, silver remains trapped in what analysts are calling a managed compression zone. Above it, the physical delivery math starts breaking in favor of the bulls in a way that could be violent and fast. But let me pull back from the short-term chart for a moment, because I want to show you something bigger. This exact scenario, paper markets divorcing from physical reality while inventories drain, has happened 3 times in the modern era, and every single time the resolution came in one direction: up, hard, fast. The first time was March 1980. The Hunt brothers had accumulated over 100 million ounces of physical silver and controlled roughly a third of the non-government silver supply. COMEX changed the rules, introduced position limits, and effectively forced liquidation. Sound familiar? Silver crashed from $50 to $10. But here's the part nobody tells you. Within 18 months of that forced crash, silver had found a structural floor and began one of its most persistent multi-year recovery cycles in recorded history, because the physical reality never changed. The metal was still real. The paper was still fiction. The second time was 2011. Silver ran from $17 in September 2010 to $49.51 on April 28, 2011. COMEX raised margin requirements 5 times in 9 trading days. 5 times. Which forced a cascading wave of margin calls and liquidations. The price collapsed 35% in 2 weeks. Traders who sold at the bottom were devastated. Traders who understood that physical industrial demand hadn't changed, that nothing fundamental had shifted, bought into that weakness and watched silver recover and stabilize at levels that were, even at the lows, dramatically above where the rally started. The third time was January 2021. The Reddit-driven silver squeeze generated massive physical buying pressure and sent silver spiking to $29.30 in a single weekend. COMEX raised margin requirements again. Brokerages restricted buying on physical silver products. The squeeze was broken, in paper. But here's what happened over the following 4 years. The structural supply deficit that those retail traders were pointing at turned out to be completely real. Every single year from 2021 through 2025 ended with the world consuming more silver than it produced. 5 consecutive years of structural deficit. Cumulatively, according to HSBC's 2026 silver outlook, the global shortfall has accumulated to approximately 800 million ounces since 2021. That's nearly a full year of global mine production just gone, consumed, burned into solar panels that will never release their silver back into the market, embedded into EV battery packs with a 5 to 10 year recycling life cycle, etched onto semiconductor wafers that nobody's going to melt down for a spot price. Now let's talk about where we actually are in the cycle, because this is the aha moment. Those 3 historical squeezes, 1980, 2011, 2021, all share a common signature before the resolution. A manufactured paper market crash that created the appearance of normalization while the physical market continued tightening underneath. The charts look calm, the headline prices look manageable, but in the vault data, in the delivery reports, in the lease rates, those numbers keep screaming. Right now, the COMEX Stress Index is at 81. The coverage ratio, the percentage of paper claims that could actually be satisfied with registered inventory, is in what the exchange itself describes as stress territory. According to goldsilver.ai, which tracks this daily from official CME data, we have 6.9 times more paper claims than deliverable metal, and the inventory is draining at 785,000 ounces per day. The exchange estimates, at current withdrawal pace, that registered silver could be fully depleted in approximately 80 trading days. That's roughly June 2026, before summer. But wait, let me show you the smoking gun, because what makes this situation different from any previous squeeze, what makes March 2026 the genuinely unprecedented moment that serious metals analysts are pointing at, is the industrial dimension. Let me give you the numbers that the casual investor is completely missing. Global silver industrial demand hit a record 680.5 million ounces in 2024, according to World Silver Survey data. Total silver demand globally reached 1.16 billion ounces that same year, also a record. Mine supply, 819.7 million ounces. The math there isn't complicated. You're consuming 340 million more ounces than the Earth produces every single year, and it's accelerating. Solar panels alone are projected to consume 240 million ounces in 2026. Each photovoltaic panel requires between 15 and 25 grams of silver. By 2030, the solar sector alone may need 820 million ounces annually, roughly equivalent to today's entire global mine production. Just the solar sector. Now add electric vehicles. A single EV uses approximately 50 grams of silver. That's 2 to 3 times more than a conventional gasoline car. And EV production is not slowing down. It's accelerating. The Silver Institute's research, conducted in partnership with Oxford Economics, projects that EVs will overtake conventional vehicles as the primary source of automotive silver demand by 2027. By 2031, EVs are expected to account for 59% of the global automotive market. The automotive sector's silver demand is growing at 3.4% annually through 2031. And then there's AI infrastructure, the data centers, the PCBs, the thermal interface materials and servers, the silver-plated connectors running at 400 gigabit speeds. Silver is a bottleneck material inside the AI compute revolution, and nobody in the mainstream tech coverage is talking about it. What's the result of all this converging demand against a flat supply base? The Silver Institute projects cumulative supply deficits through 2030 could reach 1.5 billion ounces. 1.5 billion. Against annual mine production of roughly 820 million ounces. The math does not resolve without a price that is dramatically higher than $83.48. Now here's where the paper versus physical disconnect becomes visible in a way that should make every rational observer stop and ask hard questions. Silver's spot price on March 6th is $83.48. That price is set primarily on COMEX through futures contracts, paper instruments that represent 6.9 times more silver than actually exists in deliverable form. Meanwhile, the Shanghai Futures Exchange, China's primary silver trading venue, has been showing premiums of $3 to $5 per ounce above the COMEX paper price. That spread shouldn't exist in a rational, globally integrated commodities market. When a physical buyer in Shanghai has to pay more than a paper buyer in New York for the same metal, it tells you something fundamental. The paper price is not telling the truth about the physical market. And this isn't just a Shanghai observation. Let's look at London. According to Japan Bullion Market Association data, London silver lease rates spiked to 34.9% in October 2025, with intraday peaks reaching 39.2%. Lease rates on silver, what it costs to borrow physical silver from a vault for a period of time, normally run below 1%. Below 1%. They hit 39.2%. That is a 39 times increase in the cost of borrowing physical metal. By late October, they had retreated to approximately 5.6%, still nearly 6 times normal. That kind of lease rate behavior doesn't happen in a market that has plenty of metal. It happens when the metal is genuinely scarce, and whoever holds it knows it. Let me give you one more data point that connects the dots completely. Shanghai Gold Exchange silver inventory. In November 2025, it stood at 559 metric tons. By February 2026, it had fallen to 318.5 metric tons. That is a 43% decline in 3 months. The world's 2 largest silver delivery exchanges, COMEX in New York and the Shanghai Gold Exchange in China, are simultaneously and independently draining. These are separate systems. They don't share metal easily. There's no arbitrage pipeline between a New York COMEX vault and a Shanghai warehouse. and yet both are draining at the same time in the same direction at historic rates. This is global physical demand overwhelming global physical supply simultaneously on two continents. Think about what that means for the price discovery mechanism. The price, the $83.48 you see on your screen right now, is being set by a paper market that is floating 6.9 paper claims per ounce of real metal, while the real metal is leaving both the New York and the Shanghai systems simultaneously. One of these signals is correct: the screen or the vaults. The vaults don't lie. Now, let me address something directly, because I know some of you are thinking, if this is all so obvious, why hasn't the price already exploded? And this is actually the most important question you can ask, and it deserves a serious answer. The answer comes in two parts. First, price suppression through paper market mechanics is documented and well established. Margin hike cycles, raising the amount of money traders must post to hold futures positions, have been used historically to force liquidations and break rallies. We've seen it in 1980, 2011, 2021, and January 2026. When COMEX raises margin requirements, it costs more to hold a long position in silver futures, which forces leveraged players out of the market and creates selling pressure that has nothing to do with the actual physical supply-demand balance. It's a mechanical squeeze of the paper market, not a reflection of physical reality. Second, and more fundamentally, physical market dislocations take time to propagate into paper prices. The system has enormous inertia. But when the dam breaks, when the physical delivery demands cannot be met from registered inventory, the repricing is not orderly. It is not gradual. Historical precedent shows that physical supply failures in commodity markets produce gap-up moves that leave most traders completely wrong-footed. So let's talk about what's happening with institutional positioning right now, because this adds another layer. Managed money positioning in silver, the speculative long contracts held by hedge funds and institutional players, collapsed 77.72% year over year. In February 2025, managed money held 54,415 long contracts. In February 2026, that number dropped to 12,121 contracts. That's the speculative community at its most pessimistic on silver in years. Here's the irony that should make you think. At the exact moment when institutional speculators have largely exited the silver futures market, physical delivery demands are at all-time records. February 2026 just set the record for the highest February delivery volume in COMEX history. January 2026, which is traditionally a non-delivery month where you'd typically see 1 to 2 million ounces delivered, saw 49.4 million ounces delivered, a 7.27 times increase over 2024's January level. The people demanding delivery aren't speculators. They're industrial end users, electronics companies, solar manufacturers, EV producers. They don't care about the paper market. They need the metal to keep factories running. And they are pulling it off the exchange at a rate that has never been seen before. This combination, peak speculative pessimism overlapping with record industrial physical demand, is historically the setup that precedes the most violent silver price moves in both directions. And given the direction of the structural forces at play, there's really only one logical direction for this to resolve. Now, I want to make something very personal and practical for you, because this is where I talk about what this actually means for you specifically, whether you're already in silver, thinking about it, or just trying to understand what's happening in the broader financial picture. If you're a trader watching silver on the short-term charts, the next 72 hours around $84.33 represent a genuine inflection point. A sustained close above that level, particularly on volume, signals that the delivery-driven physical demand is beginning to overwhelm the paper market suppression. The technical picture mirrors the structural picture. Both are pointing to the same level. If you hold physical silver already, coins, bars, rounds, the COMEX data is actually reinforcing your position in a way that paper prices currently mask. The premium structure in the physical market is already reflecting tighter supply. Your metal is priced differently and more accurately than the futures screen shows. If you're considering entering the silver market for the first time, I want to be very clear. This is not financial advice, and I'd encourage you to speak with a qualified financial professional about your specific situation. Every person's risk tolerance, timeline, and portfolio allocation is different. What I can tell you is that the structural case, 5 consecutive years of supply deficit accumulating to roughly 800 million ounces, industrial demand growing at rates that mine supply cannot match, and exchange inventory draining at 785,000 ounces per day, those are documented facts, not speculation. The Silver Institute projects this will be the 6th consecutive deficit year. JP Morgan's own research projects silver averaging $81 per ounce for 2026 as a conservative baseline, while more bullish institutional forecasts go as high as $226 per ounce by year-end. Here's something specific to watch over the next 72 hours. March is the primary delivery month for COMEX silver contracts. First notice day was February 27th, and delivery continues throughout March. As of early March, 10,526 contracts, 52.63 million ounces, had already stood for delivery against registered inventory of 86.1 million ounces. That means, in the coming days, as additional delivery notices are filed, the registered inventory buffer is going to get increasingly thin. If delivery demand continues at anywhere near the pace of January and February, where the delivery rate hit an extraordinary 98% in February, meaning 98% of open interest actually stood for physical delivery rather than rolling to the next contract, then by mid-March, the math starts getting very uncomfortable for the short side of the paper market. Watch the CME warehouse reports, published daily. Watch the registered inventory number specifically. If it drops below 75 million ounces while March delivery is still ongoing, that is a signal that the system is under genuine stress. CME's own stress index is already at 81 out of 100. The all-time high is 88. We are close to territory that has never been charted. I also want you to watch something that most silver coverage never talks about: China's export license restrictions on silver. Starting in January 2026, China tightened its silver export licensing regime. China consumes over half of global industrial silver for solar manufacturing, EV production, and electronics. When China tightens export controls on a material it simultaneously consumes in massive quantities, it means the domestic price pressure is being felt and the government is protecting domestic supply chains. This policy move effectively removes a potential source of emergency supply from Western markets. The Shanghai Futures Exchange showing $3 to $5 premiums over COMEX is partly a reflection of this dynamic. Chinese buyers paying more in a domestic market that is becoming increasingly insulated from Western paper price discovery. Let me also give you the macro context, because silver doesn't exist in a vacuum. The Federal Reserve is widely expected to hold rates steady in March. Markets are currently pricing in approximately 2 rate cuts by year-end 2026. A softer US dollar outlook is an explicit tailwind for precious metals broadly. Real yields remain suppressed relative to historical norms. The macroeconomic backdrop, rising deficits, election cycle spending commitments globally, and persistent geopolitical risk from the US-Israel-Iran situation that pushed investors into safe haven assets in early March, is structurally supported for hard assets. Darius Dale, founder and CEO of 42 Macro, put it directly this week, noting that global liquidity is trending higher, the US dollar outlook is softening, and the geopolitically driven supply-demand imbalance in the treasury market remains unresolved, all of which reinforces the long-term case for hard assets amid financial repression risk. Silver sits at the intersection of all of it. It's an industrial necessity. It's a monetary asset. It's a safe haven instrument in geopolitical stress. When all three of those demand drivers align simultaneously, and they are aligned right now, silver historically doesn't stay suppressed for long. Here's what the historical pattern from 1980, 2011, and 2021 tells us about what happens next. In every case, the manufactured paper market crash that created the illusion of resolution was followed within weeks to months by a resumption of the physical supply pressure. In every case, the traders who sold into weakness, who believed the paper price crash meant the structural problem was solved, were wrong. The structural problem was never solved. It was temporarily papered over, literally. The difference in 2026 is that the industrial demand dimension is entirely new. In 1980, the Hunt Brothers squeeze was speculative. In 2011, it was primarily investment-driven. In 2021, it was retail-driven. In 2026, the delivery pressure is coming from manufacturers who literally cannot substitute away from silver and keep their production lines running. Samsung's solid-state battery technology, which is beginning to move from pilot lines to the 2026 luxury EV market, uses silver-carbon nanocomposite anodes that may require up to 1 kilogram of silver per 100 kilowatt-hour battery pack. Even a 5% market transition to that battery technology represents a structural demand shock that no one in the price discovery mechanism has fully priced in yet. We are, right now, watching the paper market's final attempt to maintain control of a physical commodity that the physical world has decided it needs more than the paper world can pretend to supply. The $84.33 level in the next 72 hours is a microcosm of a much larger story that is playing out across months and years. Short-term traders will obsess over whether silver closes above or below that resistance. The longer-term structural story is that registered COMEX inventory is draining at 785,000 ounces per day. The world has run a physical silver deficit for 5 consecutive years, accumulating to 800 million ounces, and the industrial users who actually need the metal to build the solar panels and EVs and AI servers that the global economy is betting its future on are pulling silver off the exchange at rates that have broken every historical record. The people who didn't see the silver story in 2021 when the deficit started, the ones who dismissed the squeeze and watched from the sidelines as silver doubled over the following 4 years, had access to the same data you're looking at right now, the same COMEX reports, the same Silver Institute surveys, the same vault drain numbers. The information was there. The question, as it always is whether you're paying attention. So let me bring this full circle, because I opened with 86.1 million ounces. That is the registered COMEX inventory number. On February 27th alone, 52.63 million ounces were demanded for delivery from that pool. The COMEX Stress Index sits at 81 out of 100. The drainage rate is 785,000 ounces per day. The Shanghai Futures Exchange shows a $3 to $5 premium over paper price. London lease rates hit 39% in October, 39 times the normal rate. 5 consecutive years of structural supply deficit. 800 million ounces of accumulated shortfall since 2021. Solar demand projected at 240 million ounces this year alone. China tightening silver export controls. And silver sitting at $83.48, while the all-time high set just 37 days ago was $121.62. One of these things is not like the others. Either silver is genuinely worth 31% less than it was 5 weeks ago because the world's need for it has fundamentally changed, or the paper market is having one final argument with physics, and physics is going to win. The $84.33 level over the next 72 hours is where that argument gets its next chapter written. Watch the CME warehouse reports. Watch the March delivery data. Watch the COMEX Stress Index. Not because I'm asking you to take a position. Again, speak with a qualified financial advisor about your specific situation. This is not financial advice. But because what happens in the silver market right now is a real-time case study in what happens when the paper economy tries to price a physical reality it can no longer fully control. Drop a comment and tell me this. Do you think the paper market can hold silver below the $84.33 level through the March delivery cycle? Or do you think the physical delivery data we've just walked through is going to force a repricing? I read every single comment. Your analysis and your questions shape what I cover next. And this community has consistently surfaced data and angles that I've taken directly into research for future videos. If you've made it this far and you're not subscribed, please do it now. Hit the notification bell while you're there. The next video is going to go deeper on the May contract math, because if March creates the delivery stress the data is pointing to, what happens to the May open interest that's already building is going to be a story of its own. And you're going to want to have seen this one first. The signs were there before the 2021 squeeze. They were there before the 2011 blow-up. They were there before Silver Thursday in 1980. The data is always there for those who are willing to read it. The only question is who is positioned correctly when the physical market finally forces the paper market to agree with the vaults.